$47 million in undisclosed margin leakage just appeared in a Fortune 500 latest 10K item 9A, and your employer might be next. If your company has a material weakness in sales discount controls, here's what that actually means for your personal tax return. Most people believe this. If my employer's accounting is messy, that's their problem. My W-2 and 1099 income are locked in and safe from audit exposure. That belief is costing high-income professionals six figures in unforeseen tax liability. Here's the reality backed by IRM 4.10. 3. When the SEC flags internal control weaknesses in revenue recognition or sales discount approval, the IRS audit selection algorithm doesn't stop at the company. It extends upstream to employee compensation, incentive payouts, and related party transactions. A $200K, $500K earner facing triggered examination could face $40,000 to $200,000 plus in amended liability, penalties, and professional fees, plus 12-18 months of audit uncertainty. Let me show you how this works and why you need to know it before April. First, the mechanism. Ask 606, the revenue recognition standard, requires companies to record revenue when control of goods passes to the customer. But when sales teams approve discounts outside formal channels, email approvals, verbal sign-offs, shadow spreadsheets, the revenue timing gets murky. The discount approval doesn't flow into the accounting system cleanly. Revenue gets recorded at the full price, then adjusted weeks or months later when someone finally reconciles the shadow list. That's a material weakness. It gets disclosed in Item 9A of the 10K. When that disclosure hits the SEC filing, the IRS's CRET system, Compliance Research Evaluation and Technical Sourcing, flags it. Per IRS Publication 583, the audit typically expands to examine the compensation tied to those revenue numbers. Here's why. If revenue was misstated or timing shifted, bonuses and commissions tied to that revenue are now potentially misstated too. Your bonus check may have been based on revenue the IRS later disallowed. Second, the personal impact. A high-income professional in the $250K band earning $50,000 in annual sales incentive faces a specific scenario. If the company's discount approval process inflates Q3 revenue by deferring $4 million in discounts to Q4, and your Q3 bonus was triggered by hitting a $10 million revenue target, you may have received a bonus on revenue that was later reclassified. When the company amends its revenue recognition via Form 3115, Application for Change in Accounting Method, the IRS looks back 7 years per standard audit lookback. Your bonus income from those years now requires reclassification or disallowance. The amended tax liability hits in 3 ways. First, ordinary income recalculation. If the bonus was never legally earned because the triggering revenue was misstated, you owe tax on income you shouldn't have received. Second, alternative minimum tax AMT recalculation. High-income filers in the $200K, $500K range often trip AMT on large bonus years. A $50,000 bonus recalculation can add $12,000, $18,000 in AMT exposure. Third, accuracy-related penalties and interest. 25% penalty on the amended liability, plus IRS interest compounding backward 7 years. A $100,000 amended exposure becomes $135,000, $160,000 with penalties and interest. Third, how to identify the risk now. Pull your employer's latest 10K. Go to Item 9A, Controls and Procedures. Search for these phrases: material weakness, significant deficiency, revenue recognition, sales discounts, discount approval, internal controls over revenue. If you see language like management identified a material weakness in the design and operation of internal controls over the accuracy and timing of revenue recognition related to sales discount approval processes, that's your signal. Screenshot it. Note the filing date. Then cross-reference your bonus or incentive compensation agreements. If your bonus was tied to revenue targets, margin targets, or sales metrics in any period covered by that weakness disclosure, you have potential exposure. The company will likely remediate, file an amended 10K, restate prior year earnings, and that restatement event is when the IRS audit selection accelerates. The delta: a $200K earner with $60,000 in annual incentive comp could face $75,000, $180,000 in combined amended tax, penalties, and professional fees over a 12-18-month audit process, versus zero exposure if the weakness had been identified and disclosed proactively before your bonus was paid. The action now: review your last 3 years of bonus statements against your employer's latest 10K Item 9A disclosure. If there's alignment, consult a tax professional to model the exposure. Consider whether a voluntary disclosure amendment or documented contemporaneous documentation could mitigate audit risk. Don't wait for the IRS to mail the exam notice. Same facts, different reading. Follow the trail.